All right. Today is Monday, March 6th, and this is a recap for the stock market activities today. Now, folks, I got a good one for you tonight. Although a disclaimer, I'm kind of under the weather right now. My voice is all over the place, so apologies if I have to cut this short or produce a shorter than usual video. I did an hour show last night for the members, and I was coughing all over the place. It was a total embarrassment. It took me about 5 hours to record the video. So if you want to hear me cough, $10, baby. But I know it's too much, Maverick. I don't think I'm gonna do it. And that's okay, but you're the same guy who paid $14,000 a pop to watch Taylor Swift lip-syncing and shaking her little booty using a pair of binoculars because you're at the top of this stadium. But I know, I'm no Taylor Swift. I get that. It's no problem. But you know what I am? I'm not one of those pussy bears who freak out every time the market pops higher for these Mickey Mouse / monkey reasons. For example, lately we got a massive pop so far off the 200 days moving average, even though bond yields are moving higher, even though the Fed continues to say, we're going to crush your little heads, we're going to do this and that. But the market doesn't seem to care. What was the reason behind this recent pop? Many theories from Fed President Boystick to the technicals, to the mechanics, to zero date till expiration, to whatever Jupiter did to Uranus or to your Venus. And immediately, for the slightest pop, you get all of these bears capitulating right away. And among them, of course, is none other than Chief whatever, and also Peyton Manning impersonator from Morgan Stanley, Mike Wilson, who last week said that the equities are going to go down by over 20%. And today he says, but I'm turning tactically bullish today. And I see the S&P rising to 4150. And I say, look, the moment Mike Wilson starts to flip-flop, you know we're going down right away. There is no 4150. Forget about it. You know, when the voice of reason for all people is Marko Kolanovic, there's something going on here. Marko says that while the day-to-day interplay of investors, speculators, the option market, systemic investors, etc., can produce strong rallies, we maintain that risk assets are in a bear market and will not bottom until central banks start cutting rates. Number one, Marko, this is exactly what we said last year. Where the hell were you? But anyways, better late than never. But number two, he's absolutely right. Now, you can say it's Jupiter, it's Mars, it's Uranus, it's something that produced the rally. The way I read it is, we were supposed to go down big. For one thing, SPX 4000 was violated, and for the other, the 200 days moving average was violated. Now we're waiting and waiting for the quant funds, for the algos to start selling. This is what they were supposed to do. But then something happened. My theory is, you got all of these zero date till expiration options. The moment the SPX went down below 4000, the 200 days moving average, immediately we got zero date till expiration plays betting that the SPX will be above the 200 days moving average by the end of the day. The market maker looks at this feedback and says, okay, I guess I'm buying now. And then the algos for the quant funds, they read it the other way. They read it as if the market crossed the 200 days moving average for the first time, aka a bullish reversal. And they started buying. When they started buying, the retail mom and pops, the FOMO kicks in and they start joining the rally. And then the shorts panic. And they start covering, and you get what we got in the last few days. But it is a Mickey Mouse rally. That's all there is. And by the way, this zero date till expiration phenomenon, if the market maker decides to say, you know what, to hell with it. I am sick and tired of doing this every single day. So what I'm going to do is I'm going to make sure that all of these zero date till expiration options expire worthless. JP Morgan did an analysis on this specific scenario. What happens if the market maker says, you know what, this. I'm going to drop the SPY by 5% to get most of these zero date till expiration options done. JP Morgan came up with the conclusion that we will see a $30.5 billion worth of delta selling, which will also mean a 20% pullback. And this is, by the way, what we call volume-geddon, which Marko Kolanovic been hypothesizing about in the last few days. That it is a very distinct possibility. And again, the question becomes, what happened today? Why did we see the reversal that we got midday today? Did Jupiter abandon Uranus or your Venus or something? What happened here? They say, oh, it's China. The news that we got from China that the GDP goal is not that impressive. And therefore, we saw the China reopening trade going down down, be it the Chinese names, the Alibabas, Pinduoduos, the ETFs, FXI, KWeb, all down, and some of the commodities plays also applicable for the China reopening, steel stocks, copper stocks, chemical stocks, all down big. Or was the market reversal that we got today due to Jay Powell, who's going to testify in the Senate tomorrow? Now, my reading is the Senate will be a softball interview of Powell. They're going to ask stupid questions. All of your senators are corrupt. They're all invested in Apple and in the stock market. They want lower rates and they want higher stocks and higher real estate values. So the Senate will be, if anything, dovish/bullish. They're going to ask the softball questions, and Jay Powell, of course, will stick his foot in his mouth as he does usually. The Republicans are going to make it look like, oh, Mr. Powell, isn't it Joe Biden's fault that we have the inflation problem that we have right now? And of course, Powell is not going to grow a pair and say, you know what, Senator, I'm not going to play this bullshit politics game that you guys are playing. Matter of fact, inflation has always been a monetary oops. I didn't mean to say that, Senator. And the other team, the Democrats, will say, oh, Mr. Powell, isn't inflation a global supply phenomenon? But it has nothing to do with Biden at all. Will Jerome Powell show them this and say, look, well, according to the New York Fed Global Supply Pressure Index, there is no supply problem anymore. We actually have excess supply right now. But inflation is not going down because, once again, inflation has always been a mantra. I'm sorry. And honestly, what Jay Powell should do is show up with his Mortal Kombat mask and say nothing at all. Because every time he opens his mouth, he sticks his foot in his mouth and he has to do a cleanup job later on. And you know what would be even more dope? If Jay Powell put the mask on and every time they ask him a question, he doesn't reply at all. He just stares them in the eye with the mask on, keeps blinking, and that's it. Say nothing at all. Mr. Powell, what do you see the path of the monetary policy looking like in the next few years? Mr. Powell, don't you think that the Fed is overdoing it with the tightening of the monetary policy? Mr. Powell, why are you so eager to increase the unemployment rate in the economy? The only time when Jerome Powell is allowed to answer anything is if Elizabeth Warren start to question him about, oh, you're raising rates too much. Can you believe this to begin with? And I'm ashamed to say it, by the way, but I used to be a fan of Liz Warren because I thought that she's a champion for the blue collar, middle class, whatever. Now Liz Warren, of all people, is a champion for Wall Street. She's advocating for the Fed to reduce rates and pop the stock market higher. Who cares about inflation? Who cares about the middle class? So when she talks about, Mr. Powell, why are you... He should take his mask down and say, you know what, ma'am, Senator, whatever rate hikes we're doing right now at the Fed, I don't think they're going to impact the jobs that you have in your Cherokee Nation casino. Senator Warren, put the mask back on and drop the mic. That's it. That's all what Powell has to do. But anyways, now they're saying that the not pain, it was just a reversal today. We closed pretty much flattish. But they say the pain is about to come. And this dead cat bounce, well, it is a dead cat bounce. A top tech analyst just warned that the Fed Chair Jerome Powell's comments this week could spark a sell-off. Gee, I wonder why. All what I hear is this is a generational buying opportunity and stocks already bottomed. Stocks are cheap right now. For example, look at the free cash flow growth. It is actually the most negative it has been in almost more than 2 decades. Okay, but maybe the valuation's a little cheap. Les Young says that the S&P 500 PEG ratio, this is the PIG ratio, this is all about growth. It is actually at the highest levels we've seen since 2020. It is at the highest levels we've seen in decades, if we take 2020 out, perhaps ever. So you got a combination of companies producing negative cash flow. And oh, by the way, the valuation's at the highest ever, and bond yields are rising higher on top of that, where we can see the yield curve invergent at the highest degree since 1981. Are you telling me that this is a generational buying opportunity? You're telling me that this is a bull market that just began this year? Look me in the eyes and tell me that again. I'll smack you right in the face. And with that lovely friendly note that I just read for you, let's move on and cover the stock market activities today. And here we go. The Dow Industrial Average closing positive by 40.47 points, or a gain of 0.12%. The Nasdaq in the red by 13.27 points, or a decline of 0.11%. The S&P flattish, be it positive by 2.78 points, or a gain of 0.07%. We look at the sector's performances today. Number 1, capturing the gold medal, communication services, aka Google. And at number 2 for the silver, utilities. Number 3 for the bronze, financials. The laggard of the day by a wide margin is materials, and the reason is China reopening appears to be a bust. When we look at the advance to decline ratios, NYSE 27% advancing versus 71% declining. NASDAQ 28% advancing versus 69% declining. Now again, usually, not always, when we have suppressed ratios or exaggerated ratios, we see the opposite reaction, at least in the futures, and then whatever happens. Speaking of the futures, this time around for commodities, what do we see here? The dollar was all over the place, be it negative all in all, and therefore we have somewhat of a rally in certain energy commodities, certain softs commodities, but the picture is mixed. A lot of grains were down, led by oats. You got rough rice down, wheat futures down, soybean oil down, so is corn. On the other hand, you got soybean meal futures closing higher by about 2.5%. When it comes to meats, mixed picture. You got lean hogs down, feeder cattle futures up on the other hand. When it comes to metals, again, the dollar was all over the place, be it negative, but it did not help metals at all because we have bad news out of China. I say bad news. It's not really bad. It's 5% growth in the GDP. But the story was way overhyped, and therefore we have an opposite reaction today. So we have muted reactions to negative in metals. Yet when it comes to softs, we have mostly positive activities. The rally in OJ continues, adding yet another 3.25% worth of gains today alone. The rally in coffee continues. Cocoa, cotton, all moving higher. The lumber also closing in the green by about 1.25%. Absent from the rally today, be it flattish, is sugar futures, but the majority of the action took place in energy commodities. Muted reactions for the WTI and Brent, be it the WTI closing positive by about 0.5 percentage point, and then we have a rally in the gasoline RBOB. This is what you're going to pay at the pump. It has been an impressive rally as of late, and today it added about 1% worth of gains. Now look here. So far this year, we have a story of a rebounding inflation, and the most contributor to rebounding inflation is CPI energy. You can see the correlation here. Every time we see gas prices at the pump moving higher, and they are moving higher, it's just a matter of time before we see CPI energy catching up. In other words, will CPI energy go up or down in the next reading? The answer is it's going to be most likely up month over month. Now, you're going to have something major going down to cancel the impact of rising energy prices. Could it be shelter? Absolutely not. Could it be food? Not really. So you put it all together, and most likely we're going to have another shocking reading for the next CPI in the month of February, which is going to prompt the Fed to be even more aggressive. In the meantime, the story of the day, of course, was natural gas when it comes to commodities, because we have a massive drop again, worth about 14% or so. So is the rally bust now? It's over. It was just a couple of days of short covering and then we're done. Here's what the Wall Street Journal says about what happened today. Natural gas futures for April delivery fell 14% in morning trading as forecasters revised their near-term temperature outlooks higher. These meteorologists all of a sudden, and traders contemplated supply data showing inventories piling up fast and drillers dialing back slowly. This is not news. We already knew that. And the real reason perhaps is market manipulation, because we haven't seen such volatility in natural gas like this in a long time. If Monday's move holds, it will mark the 12th trading day so far in 2023, in which futures rose or fell by at least 7%. For all of last year, there were 44 such moves, the most since at least the early 1990s, when gas markets were deregulated. Modern futures trading took off. Some expert says the volatility reigns supreme. He said that the drop late last month to below $2 per million British thermal units felt like an overshoot, quote unquote. But so too was the sling back up to about $3 last week. In other words, he's saying, hey, there was an overshoot to the downside, then we overshot to the upside, and I don't really know what I'm talking about here. The Houston Investment Bank expects gas prices to decline to the point that power producers switch to burning gas instead of coal, absorbing excess supply and balancing the market headed into 2024. In other words, you want to be short coal, you want to be long nat gas. It's a massive drop, and the volatility is absolutely insane, but all in all, the majority of the bearish arguments against natural gas have been already exhausted, and that paves the way for the bullish argument. Now, the weather is really important because, as you can see, this is from the Washington Post. We use natural gas in this country to heat homes in the Midwest, in the mountains, and in the West Coast in California. The rest of the country, they use electricity, propane, oil. So the Midwest, the mountains, and the West Coast are really important for natural gas. And the sweet spot is if we have an average winter low temperature at around 20 degrees. Then you get the most households using natural gas. This was not the case all in all. It was warmer than 20 degrees. The beauty of that is you're going to see a lot of households in California, in LA, in San Diego, in San Francisco, heating their homes using natural gas because God forbid, 50 degrees, 55, even 60. That is too much. That is freezing in the state of California, which by the way explains why we have insane natural gas bills right now. We have a lot of restaurants here in California bailing out. They're saying we're going to be out of business because we cannot afford to pay the bills for natural gas. To heat up the stove doesn't make sense anymore. So we're shutting off. We're done. So why didn't we see the Henry Hub prices moving higher? The answer is the Henry Hub doesn't serve California. The Henry Hub that you see in the futures right now, that comes out of Louisiana, and it's mostly for exports. The top consumers in Asia and Europe, they're having milder temperatures too, and therefore we see the Henry Hub down, but natural gas futures in California sky high. Now, the viewer says, Dear Mav, what would you say about adding nat gas, UNG, or Boyle to your nightly chart analysis for the time being? Well, it might be the trade of the year, quote unquote. It would be the trade of the year if the short covering starts in a big way. But that requires a catalyst. It requires a massive storm, not here, but across the Atlantic. Now, you can't really do charts analysis for BOIL because this is a high levered index. It resets every single day, so there is no point at all in doing a daily chart analysis. You can do a chart analysis intraday using the 3 minutes chart, using the 15 minutes chart, but you can't do the daily. It doesn't make sense at all. Now, I've been saying, folks, you use Boyle. When we see these big moves higher in natural gas futures, then you take your profits and rotate to either cash or perhaps a natural gas stock, because you're going to lose your gains as fast as you made them when BOIL goes down, just like we saw today, down by over 20% in a single day. What we can do, though, is look at UNG, because UNG tracks pretty much the commodity. When we look at the weekly chart for UNG, no markings, no notes by me at all. What do we see here? Number one, the volume increased higher, and the majority of the increase came for buying, not selling. This is a good sign. Number two, we have oversold conditions in the RSI, the MACD indicator, but they're bottoming. The bearish momentum is bottoming. When you look at the MACD indicator, it's about to reverse. It's about to produce positive momentum, which will mean a rally higher for UNG. Number three, we have a gap at 14.10, which will be filled at some point. We don't know when, but it's going to be filled, which will be a major rally. Number four, could the pullback that we're getting this week, and the week is so young, still have 4 days left, but could it be a pullback in an A, B, C pattern that will take us all the way higher? That could be the case. At least this is what the bulls are hoping for. When it comes to BOIL, you want to grab the hourly chart for UNG. Every time the RSI gets way overextended, as you can see right here, take your profits of BOIL. When UNG becomes way oversold in the RSI from an hourly perspective, you buy BOIL and then you sell as we get closer to an overbought reading in the RSI. This is how you play it. But if you're gonna buy BOIL and hold it, I promise you, you're gonna lose money. Promise. No matter how high natural gas will go. Moving on to the big casino, the options market, what do we see here? The volume is subdued all in all, not as high as it was last week, but we have a change in formation here. Tesla is moving out of favor, Apple is moving in favor. For example, the hottest table today was Apple, not Tesla, with around 1.5 million contracts traded today, about 54% of those were calls. It's a stupid rally. Goldman all of a sudden upgrading Apple. We'll talk about that in the heat map analysis. We'll talk about Apple's chart in details in a minute. But at number two, Tesla, the souffle, with around 1.4 million contracts traded today. The retail mom and pops continue to buy, believing that they will see a revival of the gamma squeeze. Therefore, we have about 56.5% of the volume as calls, not puts. It will take a much higher volume to induce another gamma squeeze in Tesla. This is not going to cut it. Then at number three, we have Nvidia. NVIDIA with around 600,000 contracts traded today, although in this case we have 51% of the volume puts, not calls. The bears are attacking NVIDIA right now. They're building up their positions. It has been frustrating, but they're attacking, and they're gonna win. It's a matter of when, not if. Moving on to the unusual activities that took place in the options market today, we begin with the spread. This is a put spread for the SPY. Somebody bought the 355 puts and they sold the 325 puts, all for the expiration date April 14th, with expectations that the SPY will move down and lose more than 12.25% of its value by then, but not more than 19.5% by the expiration date. They paid about 60 cents a piece for the 355 puts, and they received in credit about 20 cents a piece from selling the 325 puts. All in all, the entry cost is down to 40 cents a piece. All in all, spending about $700,000. And then we have the ticker SAVE, SAVE. This is for Spirit Airlines. Now, it appears that the Justice Department is blocking JetBlue's acquisition of Spirit Airlines, which is not good for the stock. Today it was down big, but we have perhaps a technical rebound, maybe some oversold conditions here, and somebody's playing that by buying the 17.5 calls for the expiration date April 21, with expectations that Spirit Airlines will move higher and gain more than 7% by the expiration date. They paid around 80 cents a piece to enter. All in all, spending around $800,000. And then we have the ticker EMR for Emerson. Used to own the company a few years ago, not anymore. It has been catching a bid with the rest of the industrials due to the China reopening optimism. And of course, today we get the Johnny-come-lately analysts who are upgrading all of these stocks. You waited till the stock blasted higher, the move is already over, then you upgrade, and the stock goes down right away in the same day you're issuing your upgrade. They're absolute clowns here, folks. But somebody's following the call, and they bought the 92.5 calls for Emerson with the expiration date of April 21st, with expectations that EMR will move higher and gain more than 6% by the expiration date. They paid around $1.20 a piece to enter this trade, all in all spending around $800,000. On to the heat map. What do we see here? A mixed picture across the board, but the clear theme is China reopening goes bust. Although Alibaba held a lot better, it was almost flat, yet Pinduoduo was down. JD also held a lot better, it was positive for the day. Yet the automobile electric vehicle manufacturers from China, they were all down. The industrials all in all were down. Metals all in all were down. Anything related to packaging, shipping, all of that was down today. The resort names, the casinos were down. Anything related to China was down. And that, by the way, includes chips. We saw some weakness here in chips, even though the big caps were doing okay. Apple, Microsoft, Google, all positive today. Of course, Apple, based on an upgrade by Goldman Sachs, Johnny-come-lately, they now say that Apple could rise over 30%. And this is the first time they initiate a buy signal for Apple since 2017. And watch, this could be the top for Apple. And down we go from this point here. We also got Merck and Big Pharma, massive move today, gains of almost 4%. And of course, call options exploded higher, some by more than 1,000%. And this is, of course, in the heels of Merck announcing a new drug that boosts exercise capacity in hypertension patients. We'll see what happens, but this kind of news will initiate a lot of short covering, a lot of algorithmic buying, and Merck was definitely a winner today. We also have credit card companies, Visa, MasterCard, all outperforming today. Now, these companies don't care about inflation at all. It's good for them. So long as the consumer continues to swipe those credit cards up and down, they're going to cash in. And so long as the Fed continues to raise rates, they can raise the rates even higher. And they can kill all of these small businesses together. No wonder why Visa and MasterCard outperforming today. But among the underperformers, besides the China reopening plays, I mean, it could be related, but Tesla, the souffle, is down big, about 2% or so. This time around, of course, the company is slashing prices on the Model S and Model X. These are the most expensive models. When Tesla cut prices on the Model 3, we saw massive demand. The aggregate demand kicked in right away, and a massive stampede took place to the point where Tesla said, okay, we're going to jack prices back higher. But this is yet another indicator that Tesla has a demand problem. Forget about the Model 3. That is the exception. That will do fine. The demand for Model 3 remains really hot. But for the more expensive models, I don't know if cutting prices will increase the demand at all. I think this is a sign for trouble in Tesla, and immediately the market took notice. I would actually argue that Tesla's better off scrapping the Model S and X entirely. There is no point here. Nobody's going to buy the Model S. It is too expensive. It doesn't look different than the Model 3. And if you can afford the Model S, or even the Model X, you might as well buy the Audi electric or the Mercedes, the Porsche. You wouldn't bother buying the Model S. But anyways, that is just my take. We also have news for United Airlines, the ticker UAL, today at the Logan Airport in Boston. We were about to see a disaster as two 737s were about to make contact. And by contact, we mean the big explosion, the soft landing. How many times we've heard this story so far this year? This year alone. And what is Transportation Secretary Pete Buttigieg is doing? I have no idea. But it's TikTok here. One of those days, we're going to wake up and we're going to hear the news that two planes collided in whatever airport and hundreds of people died. And then Buttigieg is going to wake up? I don't know. And then we have another loser in Walgreens down big today. And this is in the news that our beloved governor, Kim Jong-un Newsom, is not going to do business with the company anymore. He's done. And the reason is Walgreens decided to ban contraceptive whatever in certain states. You know the deal. And of course, Governor Kim's not happy. He wants to throw red meat to his base and say, you know what? I don't care if Walgreens is offering all of the services here in California. If they don't offer the same services in Mississippi, I'm going to boycott the company. And this makes it really hard to do business here because if I'm running Walgreens, I have a different customer base in California than Mississippi. What do? You do one policy fits all? Kind of hard to do. So the expectations are that we're going to see Walgreens getting hit really hard. We have campaigns about boycotting Walgreens, so you might want to buy some call options on CVS instead. This is probably what Governor Kim did today. But anyways, moving on to the heat map for the ETFs, the dollar did not move one way or the other, but yields did. Although they were lower in the beginning of the day, and therefore we see the yield-sensitive names such as the XLU, XLP, they're holding ground for now. Although another yield-sensitive name in the real estate sector, IYR, VNQ, all red for the day. Of course, the mystery becomes, why did we see the IWM and small caps underperforming big time versus large caps versus technology, the Qs, even the S&P? We are taught that small caps are a leading indicator. When we see small caps being bought, that means a rally coming for the equities market, all in all. When we see small caps moving down big, it means that this is a leading indicator that we have de-risking taking place right now. Sooner or later, the S&P and the Qs will follow. I don't know if you subscribe to this theory or not, but if it does hold, that means we will see more pain to come across the map. Now, the only notable outperformer is the ticker TAN. This is the solar ETF. The government continues to pump solar stocks higher by offering free shit. And again, when you have big daddy buying, you don't want to bet against any of that buying. You want to go with the flow. And therefore, we see solar stocks outperforming by a lot. Just like when the big daddy Fed was buying everything, equities went higher. Everybody said, don't fight the Fed. Now that the Fed is saying, hey, we're losing the battle to inflation because we're a bunch of imbeciles and we have to raise rates even higher, we have to crush the stock market, all of a sudden folks are saying, yeah, this is the time to fight the Fed. This is absolute lunacy. Anyhow, moving on to charts, and then we're going to wrap it up. We begin with SPY, the S&P 500. What do we see here? Day number 3 for the rally, which was another gap, by the way, but this is a gap and crap because we got the gap, held that for a little bit, no volume showing up, no significant buying of call options. So what happens? The profit takers start to show up. We have Powell coming up. We have Jupiter about to hit Uranus. We got to de-risk right now. So we see a sell-off right away since we're not seeing any move higher. It has been about an hour or so. Let's start by de-risking and taking some profits, and immediately the chart goes down, and it lost one important support, 405, and it closed at the lows of the day. We look at the RSI, it got way out of control. So again, if you've been long the SPY, you waited for an hour or two, perhaps to go all the way to 409, 408. It didn't happen. You look at the RSI, way overbought, put 2 and 2 together. It made sense to take some profits here and pull it down. Now the question becomes, did it close the gap? And did we bounce off the gap? Because a closing at the lows of the day after a gap and crap is a bearish signal. On the other hand, closing a gap below and then rebounding higher is a bullish signal. Here's what happened. We did close the gap at 404.12 and caught a little bounce at the end of the day. I would have said that it is a bullish fill the gap and move higher had we closed above 405 by the end of the day. But that did not happen. So I'm going to give the bears the upper hand here. Although, when we look at the daily chart for the continuous contract for the S&P, nothing happened today. Flattish, no violation of any support. The volume remains low. The momentum indicators are curling their way higher. So in the daily charts, the bulls remain in charge. Can they stay in charge for too long? Well, that depends. We need to see a loss of a major support line. Number one, we have 4,037, but that is soft support. We need to see 3,960 being lost, but after that, it's going to become really obvious. So how do we spot that this is the real deal, that we're going to reverse, we're going to go down? Number one, loss of 4,037 on a daily closing. Number two, the volume moving higher. Number three, we see a curl back on the RSI back into negative divergence. Then that would be the leading indicator that down we go to 3,960. The likelihood is when we go down there, it's not going to hold. Now, what about the Qs? And I want to share with you the thumbnail of this video right here. This is the chart of the Qs, a daily chart. Notice that what happened so far is a carbon copy of what happened last summer. We got the massive bear market rally in the summer. Then came Jackson Hole Powell, and down we go. But all of a sudden, at around September, we got about 4 days worth of impulsive algorithmic buying, only for the chart to gap down big. We see a sudden reversal and a continuation of the bear market, meaning a continuation of the selling. This is what we're getting right now. We got a massive rally year to date. It stalled, it moved down, and then we have this mysterious 3 to 4 days worth of gapping up, but it appears that we cut it short today. We have a reversal candle. We're waiting for a confirmation tomorrow by Powell. If we get it, then down we go to fill the gap below, and after that, we're going to talk about making a new low. For now, looking at the 30 minutes chart for the Qs, once again, we got a gap and crap, a gap in the morning. We talked about 303.30 in my morning brief as a resistance target. Immediately the Qs got over there, consolidated, could not make it. And of course, if you've been holding the Qs, you're up 3 days in a row, you waited about an hour or so, you see the chart having a hard time cracking above 303.30, then you look at the RSI, not looking so good, way overextended. You see bond yields moving higher again. You see the dollar rebounding. You know that Powell is going to speak tomorrow. You put all of that together and say, okay, it's time to take some profits here. And hence, we get the flush down all the way till the end of the day, closing at the lows of the day, violating support level after support level, but not violating the most important one, which is 300. That remains intact, and that is the only good sign for the bulls here. But all in all, the action is bearish, not bullish. Yet when we look at the daily chart for the continuous contract for the Qs, did anything change today? The answer is absolutely not. Flattish closing, still not above the resistance at around 12,339, but keeping support at 12,207. Nothing happened today at all. Bad candle, sure, but you gotta see a follow-up. What we know for sure for now is we still have low volume. The momentum indicators are strengthening. We need to see them curling back down. We need to see one support level lost for the end of the day, by the end of the day, and that would be 12,207. Absent of that, the bulls are still in charge here. When it comes to the IWM, the Russell 2000, 30 minutes chart, look at what happened here. We got the gap all the way higher. It faced resistance at around 191.5. It got way overbought in the RSI. Nothing was happening. Bond yields reversing. Powell is coming. Dixie reversing. You put 2 and 2 together, you gotta de-risk, and therefore we have the sell-off all the way till the end of the day, gap and crap, but not closing below the important number. That keeps the action and the intensity still alive. Had they closed below 188, which is the important support here, we would have said, okay, the bears got it now. Next thing you know, the Qs, the SPY will do the same. But since we have a closing above 188 off oversold readings on the RSI, that makes it more interesting for tomorrow's action. Will the bulls step in and get us back to 191.5? Will the bears seal the deal and close below 188 by the end of the day? Well, it all depends on Jay Powell, doesn't it? And here it is, the Dixie, an hourly chart for the dollar, the most important chart you want to watch for. We have a sloping line of resistance. The chart is having a hard time breaking above, but it looks like we overshot to the downside, and now the chart is making a higher low, at least at the time of the recording of this video. If we do have a crossing above the line, and most importantly above 104.5, my number is 104.58 to be exact, then we got bullish bullish momentum in the Dixie, which will means bearish momentum specifically in the Qs and the SPY. When we look at the daily chart, here's the mystery, by the way. When we look at the daily chart for the Dixie, look at the MACD indicator. It is weakening. The bullish momentum has been exhausted, and now we're seeing the beginning of a bearish momentum. All in all, the daily chart says the dollar will go down. Well, if the dollar is going to go down, isn't this good for equities? The answer is absolutely yes, but here's the catch. When we look at the weekly chart for the dollar, what do we see here? The bullish momentum hasn't even started. The bullish momentum is building up when we look at the MACD indicator. What does that mean? Maybe we have a pullback on the daily chart for the Dixie, but in the long range, on the weekly chart, the Dixie is not done moving higher. It is taking a break for now, but it will break higher, which is not good for equities. So keep that in mind. We have a conflict between the dailies and the weeklies, not just in the dollar, which by the way experiencing a lot of outflows. We have a massive divergence between the dollar and yields. The 2-year and the dollar should be moving hand to hand, but recently the dollar has been underperforming by a lot. So either the dollar has a lot of catching up to do, which will absolutely rattle the equities market, or maybe the 2-year is wrong and it's going to go down. Now, let's be honest here. The 2-year is not wrong. So does that mean that the dollar is wrong and it's about to catch up big time? Not really. My reading of all of this is we have seen a lot of hawkish talk by the BOJ, by the ECB, by the Australian Bank, by the New Zealand Bank. A lot of these currencies caught a bid, and this is adding pressure on the dollar. But again, I have to caution, if the dollar is about to play a short covering rally to close the gap with the 2-year, we're going to see a massive pullback in equities. So keep an eye. But here's the contrast between the dailies and the weeklies. Look at gold, for example. What do we see in the daily chart above the important support, 1842? So far, so good. The RSI is strengthening. The MACD indicator is showing bullish momentum. Again, so far, so good. Gold goes higher, dollar goes down. Equities will go higher along with gold. Here's the problem. When we look at the weekly chart for gold, what do we see? We see peaking bullish momentum. And the weekly chart is about to cross, producing negative/bearish momentum, meaning we're not done with the downside in gold. Matter of fact, all in all, we see a bear flag formation. Does that mean that gold is saying in the short run, so far so good for equities, the rally goes on, but in the long run, down we go? Keep that in mind. What about UK oil, Brent oil, the daily chart? What do we see here? We have a closing above 85. So far, so good. This is exactly what the bulls need to see, because a closing above 85, listen to this, most importantly for the week, will confirm and solidify that we have a massive rally coming in oil. Look at the MACD indicator, slowly but surely accelerating. So is the RSI. If we have a weekly closing above 85, lots of short covering will happen in oil, and this will take us all the way back to the hundreds. Keep that in mind. And again, another example of the conflict between dailies and weeklies. We have the 10-year yield. Look at the daily chart. Below 4% for now. Big reversal candle. The MACD indicator is weakening. It's about to cross, producing red impressions on histogram indicating bearish momentum, which means down we go, maybe for a retest of 3.8 as support. Look at the weekly chart. The bullish momentum hasn't even started. We have a crossing, a reversal over a sloping, descending line of resistance. We have consolidation for now, and we're about to see the bullish momentum beginning on the weekly chart perspective. Does that mean that equities rally in the short run while the 10-year moves down to resolve the overbought conditions in the daily charts, and then equities go down and the 10-year reverses higher again, playing out the crossing on the weekly chart? I'm just reading the tea leaves here. Another one, what about the TLT? What do we see here? Daily chart. It appears that the RSI is strengthening. It caught support. It is above 100.28. We see the MACD indicator catching a bid here, moving a little higher, about to cross, about to give us green impressions on the histogram. Yet when we look at the weekly chart, what do we see here? The chart is weak. The chart has broken a pattern of higher lows. The RSI is in negative divergence. The MACD indicator is about to cross to the downside, producing red impressions in the histogram, indicating the beginning of a bearish momentum. And the same goes for the VIX. 4 hours chart, we're below the channel, couldn't make it above the channel today. We caught support from 18, okay, so far so good, in or around that zone. But you look at the RSI, you look at the MACD, the VIX could go down further in another test of 18. You look at the weekly chart, what do we see here? Sooner or later, just a matter of time, we're going to see a start of a new bullish momentum on the MACD for the VIX from a weekly perspective, indicating that the S&P will go down sooner or later. Apple, the big kahuna, hourly chart, this is what I gave you in the morning in my brief, and I gave you a few targets here. And again, these are not targets where the chart is going to stop at exactly, but these are numbers you have to watch for both as support and resistance. Breaks below will indicate selling, breaks above will indicate buying, and this is what the algos are looking at. I'm trying to get as close as I can get to what the algos are looking at, but it is almost impossible to get the numbers exactly right, but I'm trying to get as close as I can. And I gave you 152.3, 153.69, 154.5, and then lastly 156.15. Guess what happened? We got a pop in the hourly chart above the no entry zone, and it bumped its head pretty much exactly at 156.24, could not make it, ran out of gas, became really overbought, look at the RSI, and immediately we got selling happening. The good news is, for the bulls at least, the support of 153.69 remains intact at least for now. Had we closed below this number, I would have said, okay, down we go to 150, it's inevitable now. But the fact that Apple kept that support, it keeps the hope alive for the bulls that we could see another run at it, another crack at 154.60 now, and then after that 156.24. But from my perspective, forget about Goldman Sachs. Every time Apple traded above 150, it was a good opportunity to short. Every single time. And I don't think it's going to be different this time around. If anything, Apple is a lot weaker than it was last year. And folks, this is a slam dunk because when we look at the weekly chart, we have a gap, and you're not going to see gaps that big open in a weekly chart. We're going to close the gap. So at least you got to trade all the way to 150. You buy the puts, 150. Once we fill the gap, then it's up to you. You want to close, you want to double down, you want to roll, whatever you want to do. But for now, the trade is, the assumption should be, we're gonna close the gap below. Tesla, 30 minutes, what do we see here? We got a gap up, bumping its head at 200, could not make it, moved all the way down, played back and forth, at the next support, 194.55, could not make it, closed below that number by the end of the day, forming a bear flag pattern. And the assumption for now should be going down all the way to close the gap at 190.87, then take it from there. If that gap doesn't hold, then we go down all the way to 180. And last but not least, what about Bitcoin, tulips, the daily chart, what do we see here? We got a break below 23,189. The buyers did not show up. Some sellers did. And now we have a consolidation in a bear flag pattern. More selling means down we go to 20,593.34. Can the buyers initiate a rescue operation? Why would they? You got bad news about Silvergate Bank, whatever. And you got bad news from a technical standpoint because the support is now no longer 23,189. That's gone now. You put two and two together, the risk is to the downside. And by the way, if we do have a risk-on rally in equities and higher we go, how come Bitcoin is not participating? Something to keep in mind. Moving on to the conclusion of this video, what do we have in the economic calendar tomorrow? We have wholesale inventories, we also have consumer credit, but most importantly, we have the testimony by Powell to the U.S. Senate. All eyes will be in Powell, but until then, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Take care.